On to our final session here. This is the final session, right? And we'll have 4 presentations on mortgages. And we'll start with Susan Wachter presenting their work, and which has the flavor, I guess, of a concept which has been around in finance, that a little learning can be a dangerous thing, right? That when you're trading something, maybe it's either better to know everything about it or nothing, halfway between, and then the market can start falling apart. And so we'll hear about that, and then Ronel will talk to us about the vexed question of what the causation of securitization with respect to delinquency, right? Did the securitization market in some ways encourage bad loans that then fell apart, or in some other way linked to default? And I think that we have some more perspectives on prudential regulation in this area. So why don't we just, rather than keep talking myself, why don't we just go ahead and start? And we decided that we each talk 20 minutes, and then we'll open up for questions. So first, let's turn it right to Susan, if you're ready. Good. Great.
So we're sitting.
Well, actually, you can sit. I'll give you the clicker. Hang on a second.
Oh, that's wonderful.
Okay.
Thank you very much, and thanks to the organizers for this conference. We much appreciate the invitation. It's a very important topic. So the two sides of transparency, I know that over this last 2 days there's been conversation about transparency and call for transparency. And of course, after the crisis, the calls for transparency were ubiquitous. Just to quote Chairman Bernanke, because mortgage-backed securities are complex amalgamations of, and I apologize, let me start with the beginning. I will get there, but let me start at the beginning. This is a joint work with myself, Andrei Pavlov, and Albert Zebedev, Albert is here, and I will begin very quickly. Andrei will carry on, and then I will conclude, and Albert's here for any and all questions, so thank you to my colleagues. So to begin again, because of the calls for transparency being ubiquitous, in this paper we address whether transparency at all times, all places, is in fact the solution to prevent future crises. An exemplar of calls for transparency, Chairman Bernanke, because mortgage-backed securities are complex amalgamations of underlying mortgages, transparency about both the underlying assets and the mortgage-backed security itself is essential. Governor Daniel Tarullo, on the other hand, this departure from the standard practice of keeping examination information confidential was based on the belief that greater transparency of the process and findings would help to restore confidence in U.S. banks at a time of great uncertainty. And we've heard in this conference about the potential problems associated that the governor is alluding to in this comment. So runs that are caused by transparency are in fact in the literature. So we are looking at issues, and I'm going to switch to literature review first and go back. We are looking at issues that have been in the literature for a long time, and in fact there are 2 strands of literature. One is that opacity increases liquidity in the securitization markets. A classic paper by Don Gorton Holmstrom, other related papers, make the point that transparency can hurt insurance opportunities. If market participants have updated information about each other's risk, they will not want to insure each other. It will break insurance markets. So that's the negative of transparency, and it's the classic papers Hirsch-Schleifer. But the other side, the liquidity, is the more recent literature, and that's the Dung, Gorton, and Holmstrom, which basically makes the point that that lack of transparency is is good for liquidity. So we have lack of transparency is good for liquidity. We have the point that transparency can hurt insurance opportunities, and not cited here, but of course the famous and deeply important work of Akerlof, that without transparency you have potential for lemons. So where are we on this? Well, in this paper, we show how transparency in financial markets impacts the volatility of the underlying real estate markets. We show that transparency in financial markets can increase house price volatility. Now, we don't conclude in this paper that, in fact, transparency is always wrong, but we do conclude that ubiquitous, continuous transparency is wrong. With that, I turn to Andre to go through the model itself.
All right, so I'll stand up because I might want to show a couple of things. So pretty straightforward model, even though you might find it a bit controversial. So we assume you have borrowers and lenders, and borrowers behave in a very simple way. So borrowers basically pay a price that depends entirely on their income and on their on the loans available in the city. So for that particular city, so we have two cities, as we're going to see in a minute. So the price borrowers are willing to pay is basically their income plus the loans available in the city. Now, as an economist, that makes my stomach turn because it assumes no judgment on behalf of the borrowers. But as some of you may know, I live about half of my life in Vancouver, British Columbia, where actually I think that's exactly how people behave. In case you didn't know, it's the most expensive market in North America. And I think that is actually exactly how homeowners behave. So even though as economists we don't like that, I think that is actually a very realistic assumption. But it's important to recognize that there's no asset pricing here for the homes themselves. So home buyers just go to the bank and get the loan and pay whatever the maximum amount they can get. They get the maximum loan and pay that price for the house. And then the lenders are zero profit lenders, where they make a loan today and then they face the possibility of default. They either get their loan back plus some interest, or they or the homeowner defaults, in which case they get the value of the home times the price in the next period. Now that seems pretty simple, but including the price next period is what I'm sure has kept Albert up at night many nights in a row, because that makes the model slightly more complicated than it appears here. But nonetheless, the assumptions are really pretty straightforward. And then the third key assumption is that we have income shocks, which are positively correlated through time and negatively correlated across cities. So I'm thinking Portland and Washington State, right? Oregon and Washington, right? Two states competing for high-tech businesses. One wins, the other one loses. That's kind of the idea we have in mind. But it doesn't have to be that way. If you don't like that, and I can see why you might not, you can just assume there is an alternative investment for the banks that is not as affected by the potential income shock as the home market or the real estate market in one of the cities. So that's not the crucial assumption. The crucial assumption is that income shocks are correlated to time. So if you get hit today, then you're likely to get hit again tomorrow. And of course, that's a standard assumption when it comes to income, but that makes prices next period predictable, and that makes lenders want to withdraw funds from the city that was hit by the shock. So when we have that kind of situation and transparent pricing means lenders do zero profit condition, impose zero profit condition on every city, one at a time. So then what happens is income goes down, for city A, which is the city that has a shock, and then the income for the other city stays flat. The important point here is that the loans available to city A, to the city with the shock, decline quite a bit more than the income shock itself. Why does that happen? Because lenders switch from the city with income shock, the bad city, right, the unlucky city, to the city that doesn't have an income shock. Now, in our model, they are negatively correlated, right? So the fact that one city is more likely to have a shock next period makes the other city less likely to have a shock. So funds are moved from one city to another under a zero profit condition. So that's your transparent pricing, and of course, moving on to the next slide. Sorry, I switched real quick here. It's exactly the same graph, except here we have prices. So prices follow loans because, again, borrowers and homeowners are willing to take as much as they can. They don't do any particular asset pricing exercise. So prices decline a lot in the city that is hit. And then here's the scenario of opaque pricing. So under opaque pricing, lenders cannot discriminate against the city with the shock. So they have to price all their loans for the entire nation. In that case, income in city, in the income shock city goes down, obviously, but loans stay flat because lenders don't know, they cannot price different loans for different cities. They have to do the same pricing for the entire nation. And then importantly, so this is the key slide here, the prices in the income shock city decline, but they don't decline as much. Right? So this decline is because the income in that city goes down, but there's no additional decline because there's withdrawal of land. So this is very straightforward, and I've simplified a lot of things to show these slides. But the idea is, the main point is, under the opaque system, prices decline less. So there's less excess volatility. So to give you an example of how this works, this is a numerical example of how we have how the loans to CTA, that's the city with the income shock, decline with when you have higher correlation. So when you have higher correlation of income through time, the loans available to that city decline more and more. And then, of course, prices follow exactly the same path. So prices in CTA decline more when you have high serial correlation through time, even though income is constant. I mean, it has declined, but it's the same decline across the entire graph. So the bottom line, house prices are less volatile under opaque lending. Cities are able to cross-insure. So the whole point here is that you cannot cross-insure real estate. You cannot cross-insure human capital either. So the borrowers in this model use mortgage lending to cross-insure against potential income shocks. And interestingly, losses to MBS investors and lenders are smaller. Why are they smaller? Because prices don't decline as much. And the losses to the lenders depend on the next period price. There's one other step that we take, and that is we look at competition among lenders. And it's very easy to show that if you have both lenders, so we have two lenders, very easy to generalize to many. If you have two lenders, and if both of them are transparent, the shock city, the city that experienced income shock, receives the fewest loans. And then if you have one lender transparent and the other one opaque, the shock city receives a little bit more. And if both lenders are opaque, the shock city receives the most. Now in this scenario, we're assuming that we want the shock city to receive more loans because we want to make sure that prices don't decline further beyond what is justified by the decline in the income. And then, of course, exactly the opposite is true for the non-shock city. So in the city that kept their income high, receives fewest loans, receives the most loans under the transparent system and least loans under the opaque system. So then we worry about, well, how do we keep competitive lenders sticking to the opaque lending? Because every lender has an incentive to switch to transparent lending. That will maximize their profits in the current period. And the points that we make is, first of all, do not require geographic transparency. Second, you have to pay the originators or the lenders to stay opaque. So if you have long-term lenders and you pay them a little bit one way or another to stay opaque, obviously you can make that work. The moment you have a short-term play in the market, then you switch to transparent market. And with only a couple of minutes left to
So I will summarize
summarize.
and do a quick implications for policy. So let me go back to the second slide. So geographic transparency in real time is not necessarily beneficial. Geographic transparency limits risk sharing, increases price volatility of each market, increases potential losses to lenders, and competitive lenders gravitate to transparency unless homeowners pay lenders to stay opaque, or there's incentive to do so, and lenders are long-term players, and there is no regulatory requirement for transparency. So in conclusion, transparency is attractive but comes with side effects. Transparency prevents insurance opportunities, increases local house price volatility, increases losses to MBS investors. Nonetheless, transparency is necessary to avoid Akerlof lemons. So this is not the end of the story. We're working on further research in this area, and it's a matter of mechanism design for the transparency at the right time. We believe, as others, that the lack of transparency contributed to the subprime crisis. Thus, it's not a simple question of saying never transparency. But on the other hand, this model implies, and we think it has realistic components, that continuous transparency is problematic. In legislation that's being considered today, there is basically a component of it which would lead, the capital market execution component of the legislation that's being considered, which would lead to, we believe, continuous transparency and would increase geographic volatility. And indeed, as part of that same proposal, bond guarantor structure, if the bond guarantors are regional, would have the same outcomes. Thank you very much.
All right, I guess we'll just go right to Ronel, I guess. And so Ronel's going to present. I think you just escaped out of that.
Yep. Actually, I don't know how to escape.
I have right here.
I did it.
All right.
They didn't update that one. I have this one for you.
All right. Fine.
Okay, well,
Always
dovetailing right with that discussion of mortgage risk and bundling is
Can I get the remote?
Ronel's discussion here of
30
sort of the
seconds.
causality between securitization and mortgage default.
You should
And
entertain them a little.
all right.
while we load the file.
all right, well, speak among yourselves.
Thanks, Josh.
You're
There we go.
Not a problem.
Yeah,
We want it to be perfect.
well,
Can't rush perfection.
All right, there we go. It was worth the
Okay.
wait. Here we go. Okay, here's where.
so I'm going to talk about securitization, so of course the usual disclaimer that I only have one disclaimer here, that these are my comments and not those of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. And I just again want to thank the organizers. This has been said before, but I want to thank the organizers for putting together the whole conference and of course for giving me the opportunity to present this work. Okay, so I'm gonna look at the effect of private securitization on the mortgage performance, and as David said, to see to what extent securitized loans were really riskier and in which markets, And I want to also give you a little bit of a preview of some work that sheds a little bit more light on how this took place. So why do we care? So I want to try to give a little bit more contemporary applications. So, of course, regulatory reform is one important reason, not the only reason, but one important reason why we care about this. And in particular, I know Joe is going to talk about GSE reform. So two things that maybe relate directly to what I'm going to talk about today is the question of whether fixed rate mortgages were really the problem. Is that move things into securitization, and does that cause problems? And the second question is, to what extent can private securitization serve as a substitute for the GSE? So I'm not going to, I think that some of what I say is going to have some relevance to those questions. Okay, so it's not obvious that securitized loans are necessarily riskier, and there are theories of securitization, in fact, that suggest the regulatory arbitrage theory or the bankruptcy remote financing theories that suggest that actually you might want to securitize safer loans. And there are, of course, other theories that suggest that riskier loans are the ones that want to be securitized, either observably riskier or unobservably risky loans. So we're going to be interested in seeing to what extent we can find support for adverse selection in private securitization markets. So we're looking for a case in which originators maybe use private information to select and sell loans that are actually riskier than observables would suggest. So the basic test is going to be to look at, for most of what I'm going to present today, is going to just look at realized default rates. And then I'll talk about some of the limitations and what else we might be able to bring to the table. So what did I know when I wrote this paper? So when I first wrote this paper, we knew a couple things. We knew that zip codes with the most securitization were the ones in which subprime lending went up the most, and default rates subsequently went up dramatically. We also know that or maybe we knew that subprime mortgages with low or no documentation that were, quote, more likely to be securitized also defaulted at higher rates. And I had put these air quotes because the instrument, the 620 discontinuity that is well known to many of you, is a little bit controversial, and there's been some recent work that looked at that. Now, more recently, people have written about this. So there's a paper by Sumit Agarwal and co-authors that looks at default and prepayment on fixed-rate mortgages. They find that lenders actually retain default risk and securitize prepayment risk. They find little effect of securitization in subprime markets. One thing they don't look at is ARMs, and that's going to be what I focus on today. That turns out to be important. So there's also a paper, this is the JFSR conference in part, there's a paper in the JFSR that looks at California loans and finds results that are fairly similar to what we do, but I'll talk about what the differences are. And then Paul is here, so I'll shout out his work as well. So the main finding is that securitization is associated with greater default risk, not in every market, but in markets where it was more discretionary. So the place that we'll see the most is in the prime ARM market. So that's a market which is split fairly evenly between portfolio loans, GSE loans, and private securitized. And we'll see that in that market, both GSE and private securitized loans are riskier than loans that are retained in portfolio. So in fact, the Agarwal results indeed only apply to fixed-rate mortgages. Okay, this is the sample that's the kind of direct ARM counterpart to their results. Why? Because I'm going to argue that it's because the interest rate risk is lower, so retaining good loans is less costly for the lenders. We're also going to see that in the fixed rate market, the private securitized loans, the small share of private securitized loans, are also substantially riskier. Again, here, what's going on is obviously the GSEs took the best loans. Now, in markets, by contrast, that are highly dependent on securitization, we don't find an association with higher risk. So, for example, prime fixed-rate mortgages to GSE loans are safer. That's a huge chunk of the non-jumbo prime fixed-rate mortgage. Subprime markets, again, I'll show you some data in a minute, very almost overwhelmingly securitized, private securitized, we again see no effect of securitization on risk. Finally, relative to portfolio loans. And finally, the jumbo fixed rate mortgage, which was again very heavily private securitized. Again, we don't find association with high risk. I'm also going to give you some preliminary insights regarding what this private information might have been. I'm going to argue that some of it was genuinely private to lenders and investors couldn't have seen it. Some of it, though, I think is a little bit more tricky. I'm going to argue some of it may have been seen by investors, but we as econometricians can't see it, and maybe some other parties couldn't see it either, and that was what was going on. Okay, and this is work that's in progress, so I'll just give you a little bit of a flavor of what's going on. Okay, so I used the McDash data set, covers about 2/3 of originations in the years we're interested in. I'm going to focus on first mortgages originated today, just for 2005 and 6. The dependent variable of interest is the first time the loan goes 2 or more months delinquent during a quarter. Okay, so I have the standard origination characteristics. I update estimates of the house value, LTV, mortgage status, and so on. Okay. Now, just to give you a sense for how I'm going to define private securitization. So for the so if you look in, I'm going to look at what's called the investor type at 6 months after origination, which gives time for the loans to go through the pipeline. It's not quite as simple as that. I'm going to come back in just a minute to show you that there is the risk that a loan can default before 6 months, in which case it's very difficult to securitize it, and that can sometimes bias the results, and I'll show you that in just in a few minutes. Okay, so you can see that prime fixed rate, most of the loans are GSE. Prime arms split fairly evenly between the 3 main segments. I'm going to throw out FHA for most of this, and then you can see that the subprime market is overwhelmingly private securitized. Okay, so you can already see the basic results in the default hazards. So these are the hazard rates of default. The blue line is not securitized. The red line is private securitized. You can see that they're much higher. This is much higher default risk in both fixed rate and ARMs. And in subprimes, you can see, in fact, subprime ARMs, they cross. It's not really a clear pattern. And subprime fixed rate mortgages, it's a little bit higher than private securitized. Once we control for the mortgage characteristics, though, those lines are going to approach each other. Okay. So the estimate, just to summarize the estimation results, so I think I skipped this, but the estimate, the methodology that we're using is a dynamic logit model, so it's very similar to a hazard model. And the right-hand side control variables have the expected sign. So higher FICO score means lower default risk, higher current LTV, higher risk, and so on. Okay. Now, so now what about the things we're interested in, which is private securitization? So for prime mortgages, private securitization is associated with greater default risk, over 20% on average. Okay, so, and here I give you the marginal effects. So relative, for example, to the average default rate in this time of 2% per quarter, prime arms that are securitized are 0.4% higher, have a higher, 0.4% higher default risk. And similar results for the prime fixed rate mortgages. Okay, and so here you can see them right here. I've highlighted it. Right here we have a positive coefficient right here for private securitization. Now, and now just to compare, I alluded to this earlier at the beginning of the talk, just to compare all the investor types. So so you can see for prime fixed rate mortgages, GSE loans are less risky, private securitized. This is all relative to portfolio are more risky. For prime arms, all of them, including the GSE loans, are riskier. And for and we see much smaller effects for the subprime loans. Okay. Now, just one other thing. How am I doing? I have 10 minutes left. Okay, fine. So I'll also point out that in our baseline results, if you read the paper, you'll see this, private securitized loans actually look less risky in subprime markets, both subprime fixed rate, subprime ARMs, okay, which seems puzzling and actually much less risky. Why is that? Well, it turns out that this is being driven by early defaults. If the loans are so bad that they default before 6 months, they're not going to be securitized. And in fact, this is non-trivial. In 2006, a third of portfolio subprime ARMs were actually loans that had defaulted early. If we drop these, then the subprime coefficients then become positive. So I'll show that right here. You can see that all of these, it has very little effect. Just for comparison, I also dropped them for the prime sample, has almost no effect on the coefficients. These now become positive but insignificant. Okay, so again, the message is that in the subprime markets, the securitized loans are not significantly riskier, either riskier or less risky. Okay, now, in the remaining time, I want to talk for just a minute about private information. Okay, so I've kind of been waving my hands right here about what there was adverse selection. Now, to try to get a little bit of a better handle on it, we might ask, what information is there what is this private information? So we can break it down into two categories. There might be information that was available to the originators and to investors, but maybe is not observed by the econometrician. So, for example, I'm going to argue that second mortgages might be an instance of that. There's also information, though, that might be unavailable even to investors. So, for example, whether it's a joint or single application, so how risky the family is, not just the actual applicant, and also maybe finer-grained credit bureau information. So we can try to uncover some of this, and this is work in progress, but we can try to uncover some of this by merging the mortgage data with either HMDA or credit bureau data. So just to give you a little bit of a flavor, if you think about piggyback mortgages, okay? So piggyback mortgages, some of them were observed by investors. If you go to a standard data set like CoreLogic, you'll see that they say this is a piggyback, that this loan had a piggyback mortgage, and the information is not perfect, but it can be shown to actually affect the characteristics of the deal. Okay, so investors did seem to know about it. Piggyback mortgages obviously raise total loan to value ratio, and they raise default risk, and we can also see that piggybacks are more prominent in private securitized loans than they are either in portfolio or GSE loans. So this is just looking at one case, but you can see that there's about 10% more piggybacks even in 2006, which is where this is from, even in 2006 in the private securitized pools. So piggyback loans is one example of something that we, just looking at the standard LPS data set, cannot see. And it might make certainly, if you include them in the estimate, it lowers the effect of the private securitized coefficient. It makes once you control for whether the mortgage also had a second loan, then it makes the effect of securitization smaller. Now, why were these, I'll just throw out, there was somebody that did not know about piggybacks aside from us, which was the rating agencies. So it's well known, this is not a surprise, but it's known, and this may have been one of the reasons, I don't want to speculate too much, but it's known that the rating agencies did not give full weight to second mortgages when they were rating the pools of private securitized mortgages. Okay. So that's one type of private information. Another one, though, I think is something which I've never seen in a private mortgage, securitized mortgage prospectus, I've never seen in any other data set, would be further information about the application. So, for example, is this a joint application? So that's associated with a 30% lower default risk, having a joint application. And you can see, I just looked at low doc arms as a good example, you can see that there were many fewer joint private securitized mortgages. Now, why wouldn't you apply joint? Because, and this can also be shown, because if your spouse has a really bad, oh, I shouldn't have, there we go. If your spouse, was that, here we are. All right. So if your spouse has a bad credit score, it's better not to apply jointly. Okay. So that, but obviously you're riskier than you actually appear based on the application. Perfect. Okay. So I'll just show you again that this is something that probably was not observed to anyone aside from the original lender. And you can see that there's a significant correlation with whether the loan is private securitized or not. Okay. So in conclusion, we have found some robust evidence that private securitized loans were riskier. The effects are strongest where securitization is most discretionary. I'll just throw out a question for those thinking about GSE reforms. Does this really mean we want all or nothing for securitization? Just something to think about. Now, the other area that I didn't talk about is I kind of took the GSE and the private securitized and the portfolio markets kind of as separate. There was during this period some interaction, some strategic interaction between them. The private securitized market was poaching loans from the GSE, and then in 2007 the process was reversed, and that may have also had an influence on risk-taking across the whole market. That's other work that I think is relevant, but is currently in progress. Stop here. All right, so this, actually I can stop. Okay.
Yeah, I'll just speak from here. If they can bring the slides up. Yep, that'd be great. Good afternoon. So again, fine print, the standard disclaimer that these are my own views and not necessarily those of the Federal Reserve Bank of New York or the Federal Reserve System. I hope my co-authors don't disclaim the views. It's certainly, in talking about GSE reform, there is no sort of New York Fed view on this. This really is just some of our colleagues in the market group and in research talking about it. It's been a number of years since the GSEs were put into conservatorship. I'm guessing that if we questioned people at the time how long it would be before there'd be some serious discussion of what's next, people would have lost that bet, and that it's taken a number of years. But recently, there has been several bills that are trying to be marked up in the Senate and the House, the Corker-Warner, and then more recently and very similar, Johnson-Crapo bill, and then Maxine Waters' bill, and then in the House, Hensarling's bill. So we're going to contrast our own thinking to some of the designs in these bills. I think it's useful, at least now that the conversation is started. I'm pessimistic, though, that any bill is going to actually get passed this year, but I am glad that at least the discussion is getting started. So there's a few core ideas that kind of cut through these bills and our own thinking. One is the question around the need and then design for an explicit government guarantee. Certainly we have differences of views across the Senate and the House bills. And then how that guarantee, if you have it, is actually structured. We're going to talk about an idea called a vintage-based structure for that government reinsurance, quite different from what we see in these bills. And then also what is going to be kind of the industrial organization of the market. We talk about kind of create a financial market utility, which is a lender-owned cooperative. Again, one of the bills, Maxine Waters, adopts this view. Most of the others have this idea of many, many bond guarantors that are sort of competing for business, so a different market structure. So when we think about, first of all, do we need an explicit government guarantee? Well, the House came down, not surprisingly, decidedly no. In fact, the whole point is we need to get the government out of the housing finance business altogether, and so basically renouncing any kind of government guarantee. Across the Senate bills, they all basically create and acknowledge an explicit government guarantee. We'll contrast the actual design. So we're going to talk about this notion of a vintage base. The Senate bills all take a very different approach. They're insuring the MBS investor, okay, not the guarantor. So it's very similar to like the deposit insurance model we have, where think of the MBS investors like the depositor. So they're putting their money into the bank. Their deposit is guaranteed. So the rate investors who are buying MBS, they're guaranteed to get basically principal back. But it only pays off if the guarantor basically goes bankrupt. So that's like there's a bank failure. Okay, that's when the guarantee pays. And then in return, there is going to be an explicit fee paid to the government, and it's going to create an explicit fund, much like then the FDIC fees and an FDIC fund. There is a difference, though, between a bank and these bond guarantors, and one important dimension, and that is that these bond guarantors are monolines. They're only guaranteeing residential mortgages that are put into these securities. So there is no diversification across sort of different business lines. So really, they're much more similar to the private mortgage insurers. Now, that may start to raise some alarm bells in your mind if you thought about how did the private mortgage insurers do during the crisis. I think the staffers who were writing the Senate bill say, no, don't worry, because this is going to be better. They're going to have more capital and hopefully stronger supervision, but that is a concern. And again, if you think about the industrial organization, the Senate bills, other than Maxine Waters, they had this idea of many bond guarantors. So it's okay if one of them fails, because then the others can basically absorb that business, where Waters adopts our idea of let's just kind of make a financial market utility. So one of the, I think, important questions in thinking about any of these models is how are they going to do in a period of real market stress, especially if we think of, if we can agree on what, I missed this morning, Franklin's talk, what a systemic shock is in housing. But that's going to be something that's going to put pressure on all the bond guarantors at the same time. And so this idea that one can go out of business and the others take up the slack may not work as well in that scenario. In terms of design principles, we'd want to keep what worked. And so a lot of benefits we thought to standardization. Also, the liquidity that you get with the TBA market is something that we'd want to try to ensure. There's a lot of, we think, of economies of scale and scope in securitization. So that sort of led us to think you don't need a whole lot of securitizers. And again, this is something that varies across these models. We think it's important that you have alignment of the public and private incentives. This is all the way across the securitization chain. So one of the things that we designed in to our idea of a financial market utility is there's kind of vertical integration from the actual lending all the way up to the securitization and the servicing, where those are split apart in most of these other models. And so if you were worried about agency problems, that's something you'd want to worry about even in these new designs. All of them basically ask for more capital. So there's a general acknowledgement that the GSE simply held too little capital. And then there is this question of what do we do about affordable housing, and should we have some affordable housing lending mandates that would be imposed on whatever the new design is. And at least in the Senate bills, they have opted for the idea of let's just let them write a check. So there'd be a tax imposed, but no lending mandates and then the tax would fund various affordable housing projects on the government's balance sheet. Okay. So when we think about arguments for, should there be a government guarantee, one of the things that we thought was very important is in periods of real market stress, we think the government guarantee is going to help promote liquidity at those times. And that's very important in terms of trying to keep credit available even when markets are under stress. But more fundamentally, we took the view that we think the government owns the tail risk in housing. Whether or not they want to admit it, we can't find examples where if stress builds up enough in that sector, the government doesn't step in if they feel they need to. And so if that's the case, we think you can't sort of just wish it away, which is a bit of what we're trying to do in the House bill. but rather you should probably acknowledge it, try to figure out how can we reduce it if possible, manage it and price it. Now, of course, an argument that people make who don't like guarantees is that the government has a very poor track record of pricing any kind of this kind of tail insurance. And there's many examples that support that, but I guess my view is a positive price beats the implicit price. And there's also the transparency you get if you try to actually stipulate what is the government's role and how will it intervene, okay? But it is important, we think, if this really is, if the guarantee is really meant to be for tail risks, that's really all it pays out under, is that it really only is paying out in periods of real market stress. It's not something that would be paying out frequently. And so if you think about different designs you could use, well, I could even have added another line, which is the mortgage base. That would be an FHA, where every loan is guaranteed. But you could do a security base guarantee. The problem there, of course, is that securities can incur losses for lots of idiosyncratic reasons or regional downturns, and that really isn't going to be triggering on systemic risk. Now, one advantage of a security base is that sort of new capital for new lending isn't going to be subject to historical losses because every security is sort of self-contained, and that's a good principle that we want to come back to. You could do the guarantee around institutions. So we're saying that we're not going to let an institution fail. Well, then we get back to sort of some of the moral hazard that we talked about. Maybe moral hazard is overemphasized. But one of the nice things, again, about an institution base is once it's triggered, then any new capital coming in, again, is going to be protected against legacy losses. What goes on in the Senate bills, though, as I mentioned, is this MBS investor based guarantees. Now, that preserves some market discipline because it pays out only when the guarantors basically become insolvent. The problem, we think, under periods of market stress is that when they're required to raise new equity capital, A, it's going to be very expensive at that point in time, and that new equity capital is not just going to be subject to risks on the new lending, but also on the historical losses. And we think that's going to make it very unlikely that there's going to be a lot of new equity coming in, so we worry then about a credit contraction, much like we saw with private label securities. So we opted for a vintage base, and I'll explain. This is really just vintage. Think of this as a large pool of securities. And so what you'd say is the government guarantee doesn't pay out until the capital backing the whole vintage has been exhausted. Okay? But that doesn't mean that the entities themselves have no capital left because there is separate capital that can be still in earlier vintages. So if you took Maxine Waters' bill, they used our idea of sort of one lender cooperative, then you'd have this mutualized loss pool. There's the borrower's down payment sort of in the first loss position as well as some rep and warrants. And then the government's, the tail insurance, again, only kicks in if the whole utility is going down. Okay, so that again, we think is going to perform perhaps not well in periods of market stress. So what we do is just a couple of changes to that. First of all, just acknowledge that there's another piece of the guarantee fee, which is what the expected losses are on an annual basis. And that's going to be basically before you get into the capital. And most of the changes in the guarantee fee over the credit cycle as the underlying riskiness changes should get priced in those expected losses. But after if you experience higher than the expected losses, that's when you start eating into the capital. But the vintage approach basically, it separates the lending into these different categories based on, it could be, say, a year of lending. And what we say in this case is that the government will kick in its guarantee once a vintage has basically run through its capital. But the important distinction is that any new lending that you're doing, the capital that you're putting up against that new vintage is not subject to any losses historically on earlier vintages. Also, prior vintages that didn't have a bad performance, they're going to be paying down, and that's going to free up capital. That capital is also free to be reallocated to new lending. So the vintages create, in some sense, like watertight compartments, if you would think of a ship. And so if one or two of them flood out, the ship doesn't sink. And this, we think, is kind of an important feature in terms of trying to maintain the capacity and the willingness to keep lending in a period of stress. How would some of the, and we can see kind of from the historical, and again, it would depend on what your triggers are, but the data during the crisis suggests if we did vintages by years that within a couple of years, at least in this period, vintages started to reveal in some sense what their loss rates were going to be. So we think you could have a fairly conservative rule where you would hold all the capital for the first, say, 3 years in a vintage, and that would certainly help you know whether or not it's likely that that vintage might end up triggering the insurance. After the 3 years, if the assumption is that based on the performance to date, the vintage is doing well, you could relax the rule and say just hold the capital against remaining balances in that vintage. Okay. So the vintages we think would support market confidence, especially in periods of stress. We think this comes from the risk pooling, and this will help prevent, we think, capital flight. This is, again, new vintages are insulated from losses in the old vintages. We get this fire break. There's also very clear understanding in the market how and when the government is going to intervene. And what I think are still outstanding questions are, again, how much capital in any of these models is going to be needed depending on where we think lending volumes are going to be going in the future. And then what's the transition? So a lot of them try to allow a fairly long transition period, but really getting into the details of how do you transition from an old model to any new model is important. And how long should that period be? In terms of pricing, we did some back of the envelope sort of pricing to see how different might the guarantee fee be from the current environment. We did one example where we assumed the government is saying we're not backing anything, but we're going to require you to hold a lot more capital because we're not backing you. So we used a capital ratio of 12%. Again, we assume this 50% risk weighting. So effectively, they're going to be able to absorb 6% losses against the origination balances in these loans. We assumed a return on equity of 10%. That turns out it's a very important assumption, what we make in terms of what investors are going to want. And then you have to assume things like the expected loss rate, what the administrative costs were. But when we put in a 5 basis point expected loss and a 10 basis point administration cost, we roughed out a fee of about 90 basis points. Okay, so that is a little higher than current fees are. But if we brought in the government insurance and we said, well, because the government's taking all the tail risk, we're not going to ask them to hold as much capital. So we went to a 6% capital ratio. We kept everything else the same. We're assuming that sort of these systemic problems might come around every 30 years and when they happen, that's when you would get a full 6% loss in that vintage. When we repriced everything, it brought the guarantee fee down to about 62 basis points. So again, quite a bit lower than when we require all the lenders to completely self-insure themselves. So this, we think, reflects the advantages when you get out into the tail of having the government hold and price that tail risk rather than it being priced all in the private sector. Again, if you change the ROE, that has a big impact in terms of what the guarantee fee was going to be. We think, again, if these are prime loans, there is an argument that the lenders aren't going to need a very, the really high ROEs. But again, this is an open question, I think, in going through this. One issue is how much credit risk should you allow any of these entities to be selling off? Now, of course, part of it depends on what you're requiring to hold in capital. Corker, Warner, and Johnson Crapo require 10%, which is a really, really high if this is prime lending capital. But then they're assuming that a lot of it can be sold out into the capital markets. Part of it depends on what do you want to do with this notion of selling off risk. When we talked about this idea of junior bonds, we were thinking that what we really might want to do is to have a regulator to get some independent information on the quality of the underwriting and the lending, and so we could sell off some risky bonds. But if this is prime loans, that can't be a very big tranche of what we're going to be selling off. So that this is not selling off sort of the risky bonds is not a method to sell off a lot of the risk or reduce the cost of lending to the borrowers. It really is a way of just getting some external market betting. What you see in Johnson Crapo and in Corker Warner, though, is they're selling off much less risky bonds into the market. That, again, might reduce the cost of the lending, but now you're relying on some external financing. The question is, again, in periods of market stress, is that source of financing going to dry up? So we were arguing, well, we'll pay a little bit more in terms of not doing that, not selling all of this out into the market, to rely on more of an internal financing. So we have this capital from these earlier vintages that's basically available to refinance, in some sense, capital for the new vintages. So we thought in periods of market stress, it might be better if we're kind of using more internal capital rather than relying on the market. But that's an important question when looking at how do you want to structure the way in which you come up with whatever the capital requirement is. So let me just go right to... Then the question is, in terms of the industrial organization, we chose just to make it one basic financial market utility. We thought, given the high concentration we have with the large banks, who would probably be obvious members, it might be useful to mutualize the losses across them and get them basically incentivized to monitor each other. We thought a cooperative also would promote sort of a conservative. They're really not focused on market share. They really would be focused on basically cost efficiencies. There is a literature which talks about when are cooperatives generally more effective, and one of the things is if the members are more homogeneous and sophisticated. That's going to be true, I think, if the lenders are actually the owners here. But this is very different, again, from the Senate, from Johnson Crapo and Corker Warner, where they want to have lots and lots of bond guarantors. But again, I think the problem with their model is that it might be very good in terms of dealing with idiosyncratic risk, where a guarantor can just basically go out of business. But it's not clear to us that when they all come under pressure, it might actually be better if they're kind of mutualized in our model than basically all independent. I think the view from some of the staffers were that we really don't have to worry about that because we've set so much capital. It's not even feasible to imagine that they're all going to be going bankrupt. And the point we raised is, I think the funding problems for new lending are going to start well before any of these guarantors are running through 10% capital. Because as they start incurring losses, they're going to be asked to start putting in new capital to get back their capital ratios back up. That's when things are going to start getting dicey for these guarantors. And the other issue that we have in terms of, think about how the PMI industry worked, there was a lot of litigation around who is going to pay what. And again, the worry is the guarantors may start taking that strategy as well as they start suffering losses. And so I think an important consideration in all these models is not how they do in good times, but how well are they going to perform in periods of market stress. And I'll stop there.
All right. I think we have one more presentation, and then we'll open it up. All right. So, do you want to talk from there?
Yes, I think,
Okay, so
I think
just
everybody
still the
can hear
clicker
me, so
there?
I'll just talk from here.
okay, good.
Go a little faster.
Okay, great.
First, I would like to thank Jalapa and Franklin for giving me the opportunity to participate in this conference. Knowing that I'm the last speaker on the last day, I thought I'd shift gears and give you something to think about when you leave this evening and go to your homes. And that's what I'll describe as a too big a home problem. We've talked about the too big to fail problem. So let me present some data and get you to think about some questions which I'm going to raise about the size of homes. The first slide here basically is to get you thinking about differences in the way in which consumers spend their income. You can see from this slide, U.S. consumers tend to spend a larger share on housing than Asian consumers spend on housing. Conversely, U.S. consumers spend a smaller share on education than Asian consumers spend on education. So here there's an emphasis on what I call housing rather than an emphasis perhaps if we reallocated resources away from housing we could devote them perhaps to plant and equipment, or more importantly, to human capital as represented by education. I'd like to then present a quote by Senator Bob Corker. This was at a hearing in which he talked about reforming the GSEs and providing a guarantee, a backstop guarantee for mortgage-backed securities. It turns out, you can see, he says that by subsidizing housing the way we do, we have actually done some pretty perverse things in our society as it relates to housing. What I want to talk about is a potential perverse thing is to increase the size of houses. So the next slide shows you what has been happening to the size of housing since 1980. This slide basically shows you that the average square footage of a new home here in the United States has gone from 1,700 square feet to roughly 2,600 square feet, a 900 square foot increase, or roughly a 50% increase over this period of time. So we've gotten bigger houses, but at the same time, the number of persons per household has actually declined roughly by about 10%. Fairly straightforward. And incidentally, I don't think the size has increased due to our obesity problem here in the United States. I don't think people just need more room to move around. I don't think that's the case. But clearly, the square footage has increased. You can see not only has the square footage increased, but within these houses, we've gotten more bedrooms and more bathrooms, again, with smaller houses. Now, this slide goes back to 1940 and shows the square footage per person within a household. You can see it's almost tripled. That is the square footage per person from 1940 to 2010. You can think back, some of you, to the days of your parents in the house in which you were raised, or you can think back to your grandparents, perhaps in some cases, and see if you had a comfortable existence or not, or you felt too squeezed in relative to other members of the household. Also, you can see not only has the square footage increased per person, but there are more bathrooms. Okay, the average number of bathrooms has increased. The average number of bedrooms has increased. And this isn't oddly simply due to make more room for more kids. That hasn't been the case. I don't have any information on the so-called man caves that we hear about. Okay, I suspect that number would also show an increase. It turns out with respect to, and all this is sort of suggestive type data here, when you look at Fannie and Freddie, going again back to 1940, you see the home ownership rate, and then you see the increase in square footage. So the question here, the mandate for Fannie and Freddie basically, if you look at when they became privatized, but yet subject to government charters, in 1970 they grew, became more important in the securitization market. We have an increase in square footage of homes, but no increase in the home ownership rate. So if the mandate for Fannie and Freddie was to increase the home ownership rate, looking at this graph at least, not doing any empirical sort of analysis, one doesn't see much of an increase, if any at all, in the home ownership rate. But we do see the home ownership increased actually before Fannie and Freddie became very important. The next slide simply, and it relates a little bit to Ronel was talking about. So I decided to just provide yearly data. I was interested in what he pointed out, and as I heard him talk and read his paper earlier, he talked about private securitization, the loans in private securitization, private securities were riskier than those in the GSE securitizations, if I'm understand him correctly. What I do here is show that basically you can see I sort of shaded in the period of time in which private label securitization became an ever important part of all the securitization that was taking place. So you can see the home ownership rate went up, and of course the shaded part, I could have moved it back a little earlier, extended a little later. The home ownership went up, reached a peak, and then came back down roughly to where it was, and that's why in the previous slide you see there wasn't much of a movement. So the question here is, did private label securitization boost home ownership temporarily? And was it indeed a case in which not only did you have more delinquencies associated with mortgages underlying the private label securitization, if they were riskier, but more foreclosures. So people became temporary homeowners due to ninja loans and so on and so forth. And then basically they moved out of their homes and went back to renting, basically. So does that suggest private label securitization somehow was not regulated in a proper sort of way with respect to underlying mortgages, or does it suggest we need to worry about new private label securitization if it comes back into play? I once had the opportunity to, well, let me just move on. The last slide here, I sort of asked the question about, is it time to eliminate tax benefits for bigger homes? Now, this is a sort of a proposal that might affect some of you, but to get you thinking. This is actually average new home size per person. I did actually present or talk about this type of proposal, which I'm going to mention to Maxine Waters in Santa Monica not too long ago. And she just smiled and didn't seem to say very much. It turns out you can see there's a note there. We know we have deductibility of mortgage interest, okay, and the Office of Management Budget tallies up those tax expenditures, okay, for the deductibility of mortgage interest. And from 2015 through 2019 amounts to, if you can read the note, $456 billion. The imputed rental income, which was again carried as a tax expenditure, amounts to $441 billion. And the capital gains exclusion amounts to $332 billion, again, over this period 2015 to 2019. Now, what I'm suggesting is perhaps what one should do, given the impact on larger homes and the carbon footprint and everything out, commuting times to and from where one works and not spending enough time with one's family, all those sorts of things. Perhaps what we should do is eliminate tax expenditures, okay, whenever the square footage per person goes above some figure. Why not go back to 1980? So all those individuals benefit from these tax expenditures, perhaps will lose all those benefits if their square footage per person goes above 600 square foot per home. Or we could move it up a little bit, and that's going forward in time. So I know, we all know that a lot of economists are obviously not pleased with the mortgage deductibility of mortgage interest. It turns out there are studies showing that it does indeed lead to larger size homes. I show basically in 1986, when we eliminated most of the deductibility of interest on consumer credit, we kept the interest deductibility for mortgages. In 1986, and home sizes simply got bigger. Richard Green at USC suggests that home sizes bigger by as much as 15% or so. I'm talking here about a 50% increase. So perhaps this is something that one could think about if we think about sustainability and all those other sorts of things, as simply not doing away entirely with these sort of tax expenditures, okay, not only bring money more into the Treasury, help perhaps to some degree eliminate some of the, or a portion of the deficit, but also be a way to talk people into perhaps having less of an incentive to build ever bigger homes. Now, obviously, there's a limit, but at least we haven't yet apparently reached that limit. I think part of this is due to the subsidies, and this may be a perverse effect that we haven't given much thought tonight. So I think most of you live in probably fairly large homes. When you go home tonight, you can sort of give this a little thought. You don't have to have a nightmare or anything. I just throw this out, being the last speaker, to give you something to think about, and whether we're headed in the right direction with our subsidies, a different sort of take than what my other colleagues were talking about. Thank you.
Okay, well, while I sit here and imagine 9 people living in my house, let's just open it up to questions from the audience. I guess I'll start with that. Back there. Let's wait for the mic. Hang on a second. Just wait for the mic.
Okay, this is a question for James. So you made this distinction between spending on education and spending on housing. And I'm wondering to what extent the two are linked. Right now I'm looking for new housing, and one of the reasons I'm moving is to move into a better school district. Have you given any thought to that linkage between the two?
Yeah, we're quite right, and perhaps Susan wants to say something about that too, about where you wish to live, and obviously people with children might wish to live close to schools, particularly schools that provide a decent education for their children. So the two are to some degree, especially the price of the home relative to where one is living in connection with whether or not there are good schools nearby. It turns out that I think that is a factor, but here I'm trying to make a distinction. You don't have to have a necessarily larger home to live near a good school. You can have perhaps a smaller school, smaller home. And we are sitting, I think, at the margin, some reduction. There was for a short time a reduction in size homes. Some builders are now trying to build smaller homes. So my point is the most valuable asset in any economy is not the home per se. It's not plant and equipment. It's actually human capital. So what I'm trying to emphasize here, and it's being emphasized by Michael Milken, who has no responsibility for what I say, okay, is that we perhaps ought to stress more education, the building of human capital. That would also go to health prevention and healthcare. So maybe we have to think about a reallocation of resources, and one way to do it would be to try to take away some of the subsidies, some of the incentives to build ever larger homes.
Over there. Question. Oh, I'm sorry. Yeah.
Jim, don't you get this result with the phase out of deductions with higher income?
Not entirely, but there is a cap, as we know, on some of these deductions. But you still would, it still would affect, I think, people itemized and people, upper middle income people and lower upper income people, not truly real upper income people.
Wait for it.
Question for Joe. I thought your proposal was very interesting, particularly the notion that in the case of the mortgage markets, the government should be responsible for the tail risk. But it seems though that kind of in contrast to a lot of other things we talked about at the conference, where we're trying to completely eliminate the government bearing the tail risk. So stress testing being, maybe an example of that, or maybe I'm misinterpreting, what's going on in the other arena. But could you comment on that? I mean, should the government acknowledge that we should bear the tail risk and not worry so much about completely eliminating it?
Well, I think apropos to some of the earlier comments, there's sort of two dimensions. One is trying to reduce the probability that you get into a very stressed situation. So situations like trying to make banks more resilient so that given some level of stresses, they actually can continue to perform and lend. And so that we don't have to deal with, do we need to resolve them or bail them out? And then the other is, well, if we still end up in kind of a situation where a lot of them are under stress, what do we want to happen in that case? And I guess our point of view would be, if despite all efforts to try to reduce the likelihood that housing markets ever experience the kind of boom and bust that we saw in the last cycle, we know that if things get bad enough and credit starts to collapse, it's too important of a segment of the economy for the government to stand by and say, well, this is, when we said market discipline, guys, this is what we mean. But we are completely, I think, on board with the idea. At the same time, we want to try to do things that minimize the chance. And that's why it's a little funny to say, well, if we get hit with a systemic shock every 30 years, it's a lot of the prevention we can do, hopefully, will make it much less likely that we ever get into that situation. But I do think there is a question that if, despite all our best efforts, we again experience something where nationally house prices decline by anywhere close to what we saw, that do we want to rely on a pure private sort of self-insurance, or do we want to have the government agree to step in at some point? If the government's going to step in, I just like it to be kind of predefined. But it has to be credible, which is that they won't step in before. And when they do, they'll step in exactly in the way that they articulated. And I think that's important.
I just wanted to follow up on that, Joe. I mean, how do I put this as a question? The devil's going to be in the details here, and what we mean by sort of our best efforts. And you talked about the 10% capital requirement, but my understanding of the Johnson-Crapo bill is well, it's yet to be determined, but some perhaps significant amount of that can be simply subordinated mortgage bonds, which of course would be left to see whether they would actually ever incur losses. But more importantly, that these capital requirements can be suspended, I believe. And again, this gets at this whole common shock. It just seems like the more they start peeling that onion, the more you want to, if you're going to go down this direction, it seems to actually kind of support your approach to this problem, I guess, because I just see this thing as just coming unglued because you're going to have, the push for more lax underwriting standards, weaker capital requirements, mispricing of guarantees. I think we're just headed right back where we were.
Well, I think it's interesting that the two Senate bills do mention this idea that if it's determined that the government needs to basically waive the 10% requirement, that there's some process where they could lower it for some period of time, as admitting that their mechanism that they've designed may not be as robust as they like. The point I was trying to make to some of the staffers who were working on this is they think that would come as cumulative losses for these guarantors get close to the 10%. I told them it's going to happen way before that, because that's when they're pressuring them to start raising new equity capital because their ratios are dropping. And it's going to be very difficult. And one of the things they'll do, like we worry about banks doing, is we'll just stop new lending. So again, then you get into a situation where the government effectively is taking on more of the risk by saying, well, we're not going to require the 10%, we'll take whatever it is. Or we have to rely on maybe the FHA or some other balance sheet to step in and basically take up that lending. So that is a concern, I think.
Well, while we're waiting for another question, let me just ask one of Ronel. The connection between mortgage risk and securitization obviously runs both ways. Now you look at just 60 plus, right, delinquency, right, just 2 months. And so it seems like that's not going to be the kind of risk that would be sort of caused by the servicer's handling of the mortgage, right? The issues of forbearance and so on don't kick in yet at that point. But do you have any other results give you any sense of causality in other directions? The securitization itself, the fact that it was securitized, causing the risk? Is there anything you can say about that?
Well, other people have written about that. So
Okay.
There's been several papers by Paul Whelan, by Tomek Piskorsky, right, and Sumit Agarwal, right, that have batted this around both directions. And there does seem to be some evidence that once loans become delinquent, it's harder to work them out if they're securitized, right? But that may be, now that we're aware of that might not be something that might have been a kind of a procedural thing, and now that we're aware of it, we might be able to restructure these contracts to make it easier to do that. It's not clear whether, for example, it's something that's kind of essential, or whether it's something that if we can find, it's just a question of helping the parties contract with each other and so on.
Could I I want to just make a comment, because I once had the opportunity to be on a panel and ask Lou Ranieri, the father of securitization, a couple of years ago during the height of the crisis, whether or not securitization caused the crisis, and what his view was. What he told me, I thought it was sort of instructive. He said, securitization is nothing but a financial tool. It's how you use the securitization, what goes in the securitization, not securitization per se.
Any more questions? Does anyone want to stand up for the idea that for transparency in mortgage securitization, right? Seems like your results were pretty negative on the idea, right?
Well, negative, but it's a mechanism design question. It's certainly not negative for transparency tracking going forward, for one, and at the origination, who's creating the mortgages. So the whole reps and warrants crisis after the fact is obviously, I mean, now it's a new world. Everyone knows that the reps and warrants are going to be there going forward, but the contaminating of the pool with mortgages that were not, in fact, contractually, careful how to say this, but contractually consistent, at least has given rise to a lot of litigation. There are ways around that by having platforms with standard data, and we're absolutely in favor of that. Where we're going to is, in a sense, the moment of the crisis. That's not where you reveal. And in fact, that's exactly what happened, in a sense, because what happened was, at least to many people, it happened so fast. It's 2003, 2006. Private securitization went from 20% of the market to 50% of the market. And at the crisis point, when it became obvious, 2007, 2008, then everyone was quite interested in going back into the pools and capable of going back into the pools and finding out where, in fact, the subprime lending was pervasive. And in fact, in other work that Andre and I have done, and it's a bit like Mian and Sufi's work, we show in our work that prices went up, of course, where subprime was predominant, but also prices fell where subprime was dominant. So in fact, clearly subprime became clearly where subprime was where subprime was withdrawn. And not only was subprime withdrawn in that area, but that area became riskier for everybody. So that's exactly what you want to avoid. You want to avoid that. You want to have better pooling to begin with. That is, you want to have transparency to begin with and over the cycle. But you certainly don't want to cause runs. It's similar to kind of runs at banks by doing mark-to-market, where you have serial correlation, and in the housing market you have serial correlation. So this is exactly what will cause the real housing investment to interact with the mortgage investment in kind of a negative financial accelerator. And I think that's exactly what we saw. So so how you do transparency, and whether you need to do transparency, in some ways I think the vintage mechanism actually solves the problem, because the vintage mechanism means that it solves it and it doesn't solve it. I mean, on the one hand, in the vintage mechanism, if you had, and this is something we need to think about, and Joe, useful I think to think together about it, what is the implications of the vintage has gone bad? We know the vintage has gone bad. Do we know, and it's like a question for you, do we know transparently the geographic distribution of that vintage? And can we even tranche it and say what specifically regions have gone bad? If so, will that affect the next vintage if that's geographically transparent? So in your design, is there transparency in the vintages for geography?
So part of it would depend on the kind of industrial organization. We tried to at least argue to Senate staffers that you could do a vintage even with their model of many guarantors, but then the vintage is basically going to be guarantor specific. So you might have guarantors who are focused on a certain regional market. So then their vintages are going to have concentration in that market. And in our model, where we were basically creating a financial market utility, we're pooling across everyone at a point in time. So there would be, other than maybe shifts in the composition of lending at different points in time, we're going to get sort of a blend of everything.
So it sounds to me as that you are not going for regional transparency because you're blending it.
Excellent. Any other questions, people? Go ahead.
So a related point to what just Susan said is that in our model, everyone sees the same information. In other words, all lenders see the distribution of possible shocks, but have no private information. If there are players in the market with potential private information, if there's someone saying, oh, I see an income shock coming, I'd like to act on that, then our mechanism will prevent them from acting because they have no way of executing a trade. So that's clearly a limitation of our model and something we're concerned about right now and thinking about how to do that. So imagine someone sees a different distribution of possible income shocks than the market consensus. How do they express their view in the market while retaining the benefits of opaqueness that we're proposing?
And one of the ways to do that that's actually out there, and it's consistent with, Joe, with some of you've talked about, is the tracker models, stacker models, I should say, that Hop McManus, still here, knows a lot about. I think he's left. But having a derivative that you could trade on, and that would be price and risk revelatory. And I think when you were saying that you would have a risky portion of the bonds that would be in fact tradable for exactly that purpose of price revelation of risk, which we think is in our further work will be important.
All right. Any more questions? All right. Well, I know we have some concluding remarks coming, so, but let me jump the gun and thank the organizers. Did a tremendous job, Jalopy, and everyone else involved. And it was very interesting papers and, a great crowd. So,
So I know people have to catch planes, trains, maybe some people automobiles, so I'll be very, very brief. I think this conference has covered an incredibly wide range of very interesting topics, from the role of macro policy and systemic risk. And I think if we learned anything, it is that our understanding and knowledge and even definition of systemic risk needs some improvement and needs some further understanding. To all of the questions that have come up about designing a financial architecture that is both resilient to shocks, but also has mechanisms to deal with when those, we'll call them fail-safe mechanisms, for when the resiliency doesn't work out as hoped for. And the questions that have been raised, I think, have been very, very good ones. I want to put a pitch in for part of the design of this conference was to have a level of interaction between people who have been working on these issues from an academic point of view to folks who have been plowing the field from both a policy and implementation point of view, as well as people in the industry. I think that kind of interaction and the ability to talk across those lines is really very, very important. And my pitch, it'll be another shameless pitch as my talk before had, is we here in Philadelphia, whether at the Philadelphia Fed, in the supervision area, have built a lot of capabilities and interest with economists who are plowing the field in supervision, looking at quite extensive data sets, particularly in the area here of consumer credit. Some of that's happening elsewhere at the Federal Reserve as well. And we see it as being very, very important to make those connections. We've done that with the Wharton Financial Institution Center in the past. We expect to continue to do that in the future. But trying to make these connections and trying to make cross-fertilization happen, I think, is really very, very important. And we hope you take the opportunity now that you've gotten to meet some people in various places. Certainly, we are very open to that collaboration and hope that you all are as well. With that, I want to again thank Franklin and Atai from the Wharton Financial Institutions Center. Thank Haluk Unal from the JFSR. And of course, Jalapa, who's done so much work for us here at Philadelphia Fed. Mention that we will be getting the papers and presentations up on websites so people can have access to them. We'll have to get everybody's permission. We'll let them, if they want to make any tweaks to their presentation, but we will get that up fairly shortly. There will also be a special issue of the Journal of Financial Services Research. Papers who wish to be submitted for that will go through the refereeing process. There will be a discussion in that special issue about the range of topics that have been discussed at this conference. So with that, I want to thank all the people who participated in this conference as speakers, presenters, discussants, and the audience as well. So thank you and have a good journey home.